The market's trying so hard to rebound. No small feat after yesterday's big sell-off. Let's take a look at investor confidence levels. Joining us now, Charles Rotblut, a financial analyst at AAII. It's always hard to decide whether the market is ahead of the economy or maybe sentiment causes or momentum causes it to overreact before it really needs to with the economy. Is this justified at this point in terms of investor sentiment, Charles?
Yeah, it's hard to say. I would say under normal conditions, everybody's crystal ball is cracked, but now it seems as if they are broken into pieces. But we're certainly seeing a lot of headline risk right now. The news flow is very heavy, and I think we're seeing people react to it. But it's also worth noting when you look at the S&P 500, it was heavily weighted towards the top 10 names. And now, if you look through the end of February, the stocks that were doing well within the S&P 500 were your low volatility names, your dividend names. So there are still stocks that are doing well in this market, but certainly you're seeing a lot of turbulence in terms of not only investor sentiment, but also when you look at other indicators, such as the number of stocks making new highs and new lows. So I think right now what we are seeing, again, is a reaction to all the headline risk and trying to determine what's happening with tariffs and what's going to happen with the economy.
The Big Ten that you talk about, or whatever, the great stocks, the mags that brought these markets to these soaring levels. Is their business at this point at risk? The models for looking at 5-year earnings per share growth, just as an example, has that fundamentally changed because of these policies, or have these policies just taken the air out of the multiples that these earnings were being valued at this point? I could see that. I don't think that much has changed for these companies. They ran up to those lofty levels based on something, and not much has changed other than maybe the way that they're being valued in terms of multiples.
I agree with you. A lot of these companies tend to be more asset-light companies. Obviously, NVIDIA is making chips, but in general, I think you're starting to see some of the air being let out of the bubble in many of these stocks. When you look at NVIDIA particularly, its earnings growth is still just absolutely tremendous. And yes, it trades at a very high multiple, but analysts do expect it to maintain growth. And we're also in the early days of AI. Certainly you remember the dot-com era where we saw a lot of growth of the internet and it wasn't clear what the profit model was going to be. We're in those stages with AI right now, but I don't think those things are going to change. But I do think right now we are seeing a reevaluation of multiples as people try to determine how much impact tariffs are going to have and what implications does that have for future economic growth. I think not just in the United States, but across the globe if we do end up having a very substantial trade war.
Well, I'm not going to ask you to play technician, but I'm just wondering how much of the revaluation of the entire stock market is less related to the danger of some of these policies, and maybe at least half of it is just almost a normal pullback from levels that just seem to, 20% 2 straight years, they're just ahead of themselves, maybe. And this can't be that big a surprise when you enter a year at 23 times earnings, or maybe part of it is due to that.
Yeah, definitely part of it. I agree with you. Corrections and pullbacks and bear markets are all part of normal market activity. And I don't know if I've ever seen a correction that wasn't marked by fears of a recession. And as of yesterday, we weren't quite in a correction in the S&P 500, meaning a decline of 10% from high.
Not quite,
certainly
yeah.
We're seeing that. But I think right now there's just so much headline risk that you combine that with high multiples.
Yeah.
You have that mix going on.